So there's a lot of different tax strategies that you can implement that are super easy. Takes you 30 minutes to set up.
Most people don't realize this, but taxes are their biggest expense. Taxes, you pay a lot, so you need to focus on them. And that's why I wanted to have this conversation.
If you're conscious of the taxes that you're paying and the ways that you can minimize them, you're going to end up saving a lot of money that you can invest and put the money to work for you.
Welcome back to the channel where we discuss real estate, investing, and wealth, and where we try to help ordinary people grow cash flow and wealth. We're going to discuss strategies for W-2 earners on how they can lower their taxable income. If you guys find this content valuable, I'd really appreciate if you hit the subscribe button. It helps the YouTube algorithm, and it also helps us reach other people that we can help with financial freedom. Let me introduce Colin Van Balen again. He's owner of Windstone Financial. He has my trust. We work together. We have a working relationship. He's worked with KPMG, one of the big 5 accounting firms. Welcome back. And let's get right into it. I'm not the expert here. I'm actually not a W-2 earner. That's why I wanted to have you on. Different perspective. You're dealing with people's taxes. You're dealing with people's books all the time. Does not paying attention to taxes or just taking a blind eye as a W-2 earner, does that hurt people from building wealth?
Oh yeah, 100%. Because what I always tell people is it's not how much money you make, it's how much money you get to keep. So there's a lot of different tax strategies that you can implement that are super easy. Takes you 30 minutes to set up, and it'll defer your income, get rid of your income forever. And there's just no reason to leave money on the table. You have to pay your taxes, but you don't have to pay more than your fair share.
Yeah, I think it's a great setup. I mean, a thing that I also come to is most people don't realize this, but taxes are their biggest expense. Most people are like, oh, housing's my biggest expense. This is, my car payment, whatever, food is my big taxes. You pay a lot. So you need to focus on them. And that's why I wanted to have this conversation.
Yeah. The big issue is just that since the taxes are coming out automatically as a W-2 earner, you're just not thinking about it. It's just something that happens. Mm-hmm. So that's why if you're conscious of the taxes that you're paying and the ways that you can minimize them, you're going to end up saving a lot of money that you can invest and put the money to work for you.
Yeah. Is there a difference between people like me that are real estate professionals and W-2 earners, as we call it? And I feel like W-2 earners, we almost treat it as it's like a bad word. Like, oh, I'm a W-2 employee. From the investment side of the cash flow quadrant or the cash flow equation, as a business owner or a passive investor, it's often looked at bad. And I don't want to look at it as good or bad. It's just a different, you have to look at it differently. Is there income tax differently than real estate professionals?
The income isn't necessarily taxed differently. It's more to do with what kind of deductions and other benefits that you can get. Because the purpose of the tax code is to incentivize the things that the government wants. And the government wants affordable housing. So that's why the real estate is such a great place to invest money if you're looking to save on taxes. There are a lot of differences between the W-2 earners and the real estate investors for their taxes. Pretty much every benefit that a W-2 employee can receive, a real estate investor can also receive. However, there are some differences that we should probably go over because not all real estate investors are built the same according to the IRS.
Gotcha. Can you just, I think it'd be good to tell us what a qualified real estate professional is. I think people know what being a W-2 earner is or a W-2 employee is. That's when you're working for somebody else. You can correct me if I'm wrong on that definition. This is, you receive a W-2 at the end of the year. You're a salaried employee of a company. Did I miss anything with the W-2 employee that you'd say, hey, this is a W-2 employee?
No, I mean, that sounds about right for what a W-2 employee is. You get a salary, taxes get withheld, and that's the end of that.
And then what is a real estate professional, or what does it mean to be a real estate professional?
So to be classified as one for tax purposes, you have to spend more than half of your working hours on real estate,
Mhm.
and you have to spend at least 750 hours per year on real estate. So the reason why they added that 750 hours is just 'cause they don't want someone who's doing nothing all day that works a couple hours a month on their business. They want you to actually be actively involved. But the real estate professional, there's three kinds. There's the real estate professional, the active investor, and the passive investor. They all get the same tax benefits. However, the only difference is that real estate professionals can deduct all of their losses. Passive and active investors are limited. And then the real estate professionals can also use any income they have to invest into deferred retirement plans that offer bigger contribution limits than just your W-2 employee. And they also get something that can exclude 20% of their income from taxes called the QBI deduction. You don't get that as a W-2 earner. You don't get that as an active or passive investor. It's basically a second standard deduction, which is really nice.
So that is what a real estate professional is. I think there's also some semi gray area, but I guess you're defining it at 750. I mean, I don't know how the government would say like, hey, can you prove to us that you work 750? I mean, I don't track it.
I mean, that comes straight out of the tax code.
Yeah.
Technically have to track it.
Gotcha.
The only times they will challenge you for that 750 hours is if they see you're a W-2 wage owner and they see that your job is nothing related to real estate on your tax return. Then they're going to challenge you, like prove that you spent 750 hours on this, prove that this is half of your working hours, because that's going to be really hard to do if you have a full-time job.
Agreed. I just wanted to briefly hit what a real estate professional is. So people, if they want to know, they can research it and go down that road. But I do want to focus on W-2 earners for this particular educational episode so people can get the most out of it that are W-2. They're like, what can I do today? Can we talk about what is the standard strategies that W-2 earners can lower that taxable income that you think are efficient?
Yeah, so I have a decent list of W-2 strategies that I give out to people when they ask, what can I do now to help me lower my taxes? Is there anything I can do? There's nothing I can do. It's the end of the year. Because even if it's December, if it's 2 weeks before the end of the year, you can do a lot of these things to help lower your taxes now. And first one, super basic, is just max out your retirement plans. This is especially if you get the employer match, you're basically getting free money. You get to defer your taxes to a future period when you're going to be paying less in taxes. So it's a really great strategy. Everyone should be doing it with the opportunity. Second, if you have a health savings account, you should max that out. If you have children, you should max out your contributions to the 529 college savings plan, treated the same way as your retirement plans. Next one, use all of your FSA funds. They're tax deductible and it's use it or lose it. You don't get to roll them over to the next year. One that I like a little bit more.
What is FSA? Sorry for
flexible
interrupting.
spending plans that your employer may offer you.
Is that similar to a HSA?
No, the HSA, I mean, it's similar in what you use it for, but the HSA rolls over, compounds.
Gotcha. Okay.
FSA, I use it.
Yep, I understand.
And so the next one, tax loss harvesting. This is one that people don't take advantage of enough. So if you have some losers in your stock portfolio, you can sell them and you can deduct up to 3K in losses. Or you can sell your losers and sell the winners that performed well to offset your losses and reset your basis in your winners. So this means that when you actually do want to sell your good stocks, your capital gain will be smaller because you reset your basis. The only catch is that you have to wait 30 days before repurchasing that stock you sold. If you do it before 30 days, they're not going to allow the transaction. So another one for homeowners. So if you can prepay your property taxes or mortgage interest, this will help you exceed the standard deduction and get a bigger tax benefit. If you need the cash, obviously I don't recommend doing this, but sometimes by prepaying your property taxes or mortgage interest, this will lower you into a smaller tax bracket, which will compound the savings that you would see. Next one, charitable contributions. This only applies if you're already itemizing your deductions, because donating to charity, if you are taking the standard deduction, will do nothing to lower your taxes. It only benefits you if you're already itemizing.
Can we chat about the standard deduction? I know you're hitting all these different strategies and there's a lot there. And I want to make sure people can kind of comprehend what the benefit is too of the strategies. But let's briefly go into depth on what the standard deduction is, because most people take this, and I just want them to understand what the standard deduction is, how it works, and what you were just going to say. And I apologize for interrupting you.
No,
like if you are doing write-offs, how it affects the standard deduction. I think, do you understand what I'm asking?
Yeah. So the standard deduction is just what the government gives you to lower your taxable income. So for married people, it's like $25,000. If you make $100,000, now your tax calculation is based on $75,000. Well, if you can exceed that, the easiest ways to do it are mortgage interest, property taxes, and then some charitable contributions. If you're able to add those in and they're higher than your standard deduction, then that's what you want to do. It's very rare for you to deduct medical expenses, and it's not often anymore that people actually are itemizing. But if you do have high property taxes, you do have a high mortgage interest rate, it's going to be beneficial for you to try to do some small things like prepaying more of those taxes and donating to charity to make that lower.
What do you mean by prepay? I didn't even know how to prepay property taxes, and I'm in real estate. I didn't even know that was an option, to be honest with you. Can you give me like an example?
Yeah, so I know that some states offer you the ability to pay for, like, we're in 2023, to pay for 2024's taxes the entire year in 2023. And luckily for the tax code, it's based off when you pay it, not when the payment is for. So some places, you'll pay a little bit at a time, or you'll contribute to escrow and they'll pay it. But if you can log into your state's account and I don't know what the state's account names are, but if you log into one of those state accounts, you'll be able to just make payments and it'll apply to your future bill. You could say, I don't want the refund, keep it, and they'll apply it to the next property tax bill.
Yeah, interesting. I didn't even know that was an option. Cool. There is an opportunity cost there as well for W-2 owners. If you're doing that, you're also losing out on maybe an opportunity that, let's say if you have, $6,000 in property taxes, that $6,000 could be earning you.
Yeah, the only time I would recommend doing the prepay on these items is when we're taking a look at what your taxes owed and you're $5,000, $6,000 away from getting into that lower tax bracket, dropping from 24% to 20%, that's when it's worth doing. It's not worth doing if you're just paying stuck in your tax rate, unless you just really hate taxes. Because the opportunity cost is there. You're paying $10,000 to save $2,000. Not like the greatest return on investment, obviously.
I also want to hit the point that I don't know if you did make, but I just want to clarify for a lot of W-2 owners, because this was something that I didn't understand for a really long time. And it's with that standard deduction. If the standard deduction is, in Colin saying, $25,000, and you only have $300 in charity, and let's say you rent an apartment, so you don't have any of the mortgage interest, you're going to be taking the standard deduction. There's actually no reason for you to save documents to get paperwork that you donated the $300 worth of clothes. This was a mistake that I made for a while, until I don't know who told me, and they're like, you don't need any of this stuff. You're just getting the standard deduction. I was like, you
don't need to waste your time with that.
Yeah.
And the only reason why you donated it was because you thought you were going to get a tax deduction. You're not.
Yeah, I still don't want to discourage people from donating. I think there's still a big benefit there. But if you think you're going to get an extra benefit from bringing the piece of paper to your accountant and they're not telling you at the end of the year, hey, we're just taking the standard deduction for you anyways, then it was a waste of your time to stay there, write out the paper, save the paper, bring the paper. I mean, you're doing all these extra steps that you're getting the same result. So I just want people to realize what that standard deduction is. And if they're not going above it, which you could ask if you're working with Colin or you're working with another professional, just ask them, hey, what are my deductions? Is that the question? What are my deductions? Am I going to be over the standard deduction? Should I even worry about collecting these things? Is that what they're going to be asking their tax professional?
Yeah, I mean, they usually wait until the year's already over. If you really want to take advantage of these tax deductions, you got to be proactive throughout the year, send an email, ask a question, say, hey, I'm doing this. And they can be like, okay, this is the best way to structure it. But the greatest thing for the W-2 owners with their taxes is so far everything we've listed, very easy to implement. The hardest one to implement would be the charitable contributions. But luckily, 90% of people don't even have the opportunity to deduct a charity. So they don't have to worry about saving the receipts, taking pictures of the items they donated, all of that. Doesn't take any time to max out your retirement plans. Doesn't take very long to sell some stock through your brokerage account. Doesn't take very long to max out your college savings plan or sign up for one. So that's really the huge benefit, is the time to value ratio that W-2 earners are getting here is huge.
Gotcha. And another thing I wanted to highlight that I'm not sure that everybody understands is how the different strategies that you were listing off. Let's say it's an HSA. Let's say you're contributing to a health savings account. Let's say you're contributing to a traditional or Roth retirement account. I guess we're just going to go traditional because Roth doesn't give you any tax savings. You're paying the taxes. But if you're doing a traditional or an HSA, how does that affect your income? How does that affect how much you're paying in taxes? Can you give us like $100,000 example? And if you're doing a full contribution, what it does to your taxable income so people can understand?
Yeah. So if you have $100,000 in taxable income and you you contribute $5,000 to your HSA, now you have $95,000 of taxable income. So now your tax calculation is based off 95,000 instead of 100,000. So if you're in the 24% tax bracket, you'll save 24% of that 5,000 on your tax return.
Yeah, thank you for that example. And that's a one-to-one correlation. And I just wanted people to understand that. And that doesn't have anything to do with the standard deduction. So you're still going to get that standard deduction, correct? The $25,000.
Yep.
I think maybe now is the time for me to say, hey, I am not an accountant. I'm not a financial advisor. So just so you guys know, I'm just a real estate investor. Please consult with Colin or consult with a professional. Don't just take what I say as face value. That's why I'm interviewing Colin. But people take that standard deduction. So you're taking the standard deduction, which is lowering your salary or your earned income, your W-2 income.
Yep.
And then when you're contributing to an HSA or you're contributing to your traditional retirement account, traditional 401k, that's lowering your salary. Has nothing to do with your standard deduction. So
they all compound together. So that 100,000, you lower it by 5,000 for your HSA, lower it by 6,500 for your IRA contribution, lower it by the 3,000 from your capital losses, lower it by the $25,000 from your standard deduction. So they all build on top of each other. If you're able to take advantage of all these, you're going to significantly drop the taxes that are due. And since you had all these withholdings, you'll end up getting a refund check at the end of the year, which is really nice.
Yeah. And you can also use that refund check to invest. I mean, I just did a video, I'll link it here, that I think it was an epiphany for me, and it was on house hacking, and it was on taking my biggest expense, which statistics say your housing expenses are about 33.3%, according to some Google link. And I think that's accurate. But when you house hack and you get rid of that expense, you can take that 33% and you can put it in towards investments. And I had the epiphany when I was actually doing the episode is, wow, this is why I was able to scale and grow much quicker. Because why my coworkers, when I was a police officer, were like, how are you buying so many properties? They were paying their mortgage, they were paying their rent. And I was taking all of that, having a zero housing expense because I was renting out the rooms. And then I was taking that 33%, which, you know, when you're almost making $100,000, $33,000, putting that to another property. That's how you can purchase a new property every single year. And I think that's similar to what we're discussing, right? When we lower the amount of taxes that we're paying, we can take that delta or that difference. And if you're instead of paying 5,000 and you're really paying attention, instead of paying $5 or $10 or $15,000 in taxes, you're taking that 5, 10, 15. And if you actually are intentional and you're going to pour it into investments or pour it into something that's going to make money, well, now you're exponentially growing instead of just, you know, hey, taxes are what I pay and I don't think about them. I mean, that's what we're talking about today for W-2 earners. We want you to be just intentional of how you receive money, and that there's strategies that you can use that sometimes we aren't thinking about it. We think of retirement as this super delayed gratification, and not that it is a, what do we call it? A tax advantage, but it's a tax strategy of like, hey, I'm going to take this money. And was there anything else that, I know you were going through the list and I completely derailed you. You're hammering out the list. Was there anything left on that list? And I'm sorry if you can't.
Yeah, but before we get into what you were saying about the withholdings and investing that, what I like to have people do when we are taking advantage of these W-2 strategies is you kind of treat your withholdings as a savings account. It's not taxes that you're paying, because with all these deductions, you're going to get some of it back. It's not a bonus that means you could splurge on some random stuff you want to buy. Best way to look at it is when you get that money back, it was your savings account. You weren't allowed to touch it, so it kept growing as you were contributing money, and you use that to invest in things. That's how you grow your wealth. Lower the taxes, take the money you didn't pay on taxes, and invest in things that will build your wealth.
Yeah, I love that. It is a mindset shift. And when I'm listening to you say that, I hear people in the past being like, oh, I'm waiting for my refund to go purchase some frivolous item, whether it's a car, I heard that so many times. It didn't actually click when I was younger, of like, hey, I'm waiting for this check and then I can buy that TV or this. And what you're recommending is don't do that. That is a poor mindset. What you want to do is, hey, that's earmarked for building my wealth in the future.
Yeah, it's not free money. It's money you earned that you're just getting back.
Yeah, and a lot of people do. I mean, man, that is kind of crazy. A lot of people do a totally mindset of, hey, this is free money. This is just, I mean, this is bonus. This is my icing on the cake. And I think, yeah, it's a huge mistake. If you're listening and that's how your mindset is, let's reshift that. And like Colin mentioned, is let's shift that mindset into this is something for investing. This is something for savings. I really like that.
Exactly. Yeah.
Were there any other strategies that people can use?
Couple more. So you're talking about house hacking. You still can kind of do that with your personal home if you own one as a W-2 earner. So something called the energy efficient home improvement credit. So with this, you get a tax credit that's worth up to 26% of the cost of making energy efficient home improvements. So a tax credit is better than your deductions that we were talking about earlier, because a tax credit will directly lower your tax liability. So if you owe $5,000 and you have a $2,000 tax credit, now you only owe $3,000. But if you had a $5,000 deduction, you only get to deduct $1,000 after you multiply it by whatever tax rate you're in.
Yeah, I love that. And I didn't understand that until maybe a year ago or like 2 years ago. I just didn't understand it at all. And let me just clarify in case people missed that, because it's really important. Tax credits, which Colin is talking about, energy efficient things that you can add to your home, and you have to look again, consult your your tax professional on this one. But the same thing applies to EV cars. You can get a tax credit right now.
Yep.
And before, when we're talking about HSA, we're talking about a 1-to-1 ratio on lowering income. What we're talking about with tax credits is a 1-to-1 ratio on your taxes. So if you owe the government $10,000 at the end of the year, whatever that tax credit is, you're 1-to-1. If you get a 5K EV credit, well, now your 10K that you owed the government in taxes goes down to $5,000. So it's a
Exactly.
way bigger bang for your buck, if you will, right?
Exactly.
Some of those do have, you can correct me if I'm wrong, some of those do have income restrictions, though. So if
Yes.
you earn over 150 or 200,000, you can't get those credits. Same thing with the EV, I believe.
Yeah. So the EV tax credit, that's if you make more than 150K single or 300K married, then you can't take that anymore. But with
Gotcha.
these energy efficient home improvement credits, this EV tax credit, they're giving you credits because this is what the government wants. They want you to drive EVs and they want more efficient homes. And so the way to frame these tax credits is not like, oh, I'm paying this expense and I'll get a deduction, but I had to pay all this money for this. The way to think about it is, do you need a new car? Are you going to need to replace windows, appliances, a new roof on your home? Well, this is an incredible opportunity to repair those items, get them replaced, improve the value of your home, and you can do it right now and get a tax credit. It's not going to be available forever, but if you're going to need those items, now would be the best time to do it.
Yeah, is because they tear down. Is that why you're saying do it now?
The energy home improvement credit, that one tiers down. The EV tax credit, that's temporary. They could extend it, they might not. Depends on the success and how many manufacturers are still producing gasoline cars in a couple years.
Yeah. And these are strategies. Let me clarify, or let me ask you the question. Any strategies and I'll frame it as W-2 quadrant and the real estate professional or investor or business owner quadrant. Any of the strategies that the W-2 earner can do, the real estate professional can do the same exact stuff, correct?
Yep.
Cool. So these are for both. So this isn't just for W-2 earners, but it does, these are big bang for your bucks is what you're saying for W-2 earners.
Exactly. These are things that they can do now that will lower their income taxes, essentially.
Gotcha. Anything else? I love that one. Any other strategies for W-2 earners to be able to take home more money every year?
That's the main strategies I have that can apply to most people. But I do just want all the W-2 earners out there to be aware that the grass isn't always greener. It's not always better to be a real estate professional or a business owner. And that's because, one, the withholdings, most business owners and real estate professionals have to pay quarterly taxes on their income, and they are not doing that. So they get slapped with fines and penalties every year. They don't have to pay as much FICA taxes. That's your Social Security and Medicare. As a W-2 earner, you're only paying 7.65%. But if you're self-employed, real estate professional, you have to pay double that, 15.3%. And also the health benefits. I know that you're not going to get a tax benefit really as a W-2 earner from all the great health and benefits your employer offers, but they're going to be better for the money than what you're going to get if you have to pay for them yourself.
Yeah. No, I agree. I mean, I think it's also prudent here, since we're being so intentional about lowering our taxable income, is there's another variable that I'm going to throw in here because it's how I think. And whenever I give out advice, I always want people to know this is how I'm operating, and I want you to know the exact way that I think of it. So if I'm giving you advice, this is what I do. And I often think, if I'm going to pay, tax rates shift, so they're not always fixed. So sometimes paying taxes now, and this is you have to determine what's right for you. Me and Colin have no crystal ball. We don't know if tax rates go from, 15 to 30% to 20 to 50%, or they could go down. They could go in any way. There's
They
no,
just
no,
enact that weird sales tax rule where it's only sales tax now.
so sometimes you have to make a bet. My belief, and this is my personal belief, in my opinion, I think taxes will eventually go up. They can't stay low forever, semi to how the government was lending out money on mortgages at a 0% interest rate, or lending out money at a 0% interest rate. They can't stay like that forever. It doesn't make any sense. Again, we're, just with how the state of the economy is, we're in a massive deficit, and we're constantly spending. Somebody's got to pay for it. So the
I agree
lever that the government pulls is, hey, I'm going to pull the tax lever because we are in a deficit. And that's usually the lever they pull. They don't have too many levers to pull, but that's one that they do have to pull. I'm just going to raise taxes.
Yes, I'm an accountant, so I'm naturally more conservative with the finances. So the way I look at it is just assume they're going to be higher in the future. And also another way to frame it is at your job, every year you might be getting these inflation adjustments, like 2%, 5% raise every year. You might get promoted and get another raise. And at the time, it feels really small, but 2% compounds every single year. It's 2% on top of the previous 2%, and then on and on and on. And then what do you know? You're in a super high tax bracket just because of the normal inflation bumps. You're not actually getting any more money because it's just an inflation adjustment, but you're going to get bumped into a higher tax bracket because they didn't change those.
Yeah. I guess the other thing, I believe there are advanced strategies for W-2 earners, and I have a thesis that are there some advanced strategies such as oil and gas, or short-term rentals that W-2 employees are using to lower their taxable income?
Yeah. So one item is the backdoor Roth, allows you to deduct some traditional contributions and still be in a Roth IRA. It's complicated and you have to structure it correctly to make it work. A lot of people do it wrong, or they end up paying penalties and premiums on what they already contributed, and it's a waste of time. But for some advanced strategies for, I guess, your short-term rentals, there is something called the Augusta rule, named after all the people who are lucky enough to have houses on Augusta for the Masters. They leave town for those 2 weeks that everyone's there, and they don't have to pay any taxes on their income. So if you own a rental property or even just your own home, you're going on a long vacation, put it on Airbnb for 2 weeks, those 14 days of that income is not taxable at all. You don't have to report it. You don't have to file anything. It's free money from a tax standpoint. And so another thing that you could do with these rentals is rent it out to yourself. So this only works if you have a business and some other property that you can do this with. So maybe you're a W-2 owner, but your wife is managing properties and has a rental property, or vice versa.
Yeah.
What can happen is you take this property that you are currently not able to deduct the losses on because you're a passive or active investor. So you have loss limitations. You can't deduct anything. And you have this business income that you're going to have to pay taxes on. What you can do is you can rent this out to your business at the fair market price, of course, shift that income over to the rental property so that the loss gets wiped out, and then your business income lowers, and now your rental property is at zero, basically. So you're saving yourself taxes. You're not losing any money. You're just paying yourself, shifting the income into a different bucket so you can take advantage of your depreciation and all your deductions on the real estate side.
It's too complex for me.
Yeah. Yes, the advanced ones. So I had to come out with that one. It's best if you have a business and a rental property, but so many people do it. People have duplexes where they'll do another advanced strategy, the cost segregation, where they accelerate the depreciation, but you can only, let's say they're an active investor. So you're an active investor in real estate. That means you're managing the property. You can only deduct $25,000, but if you make more than $150,000, you can't deduct anything. And a lot of people who have rental real estate, they're making more than that. So they'll have this loss that's just sitting there. They can't use it. So they'll rent half of that building out to themselves, or half of the duplex, or the whole thing. They'll pay the fair market rate. You can't pay yourself $40,000 for 1 month. Gotta be fair. And by doing that, they can take advantage of all those cost segregation deductions that are just sitting there unused and lower their income that's being reported by the business.
Gotcha. But that means they have to be making less than 150.
No, this is for if you're making more. Because if you're making less,
Gotcha.
you're fine. But usually if you got those rental properties, you got a business, odds are you probably have more than 150.
So if you're making more, you can do the cost segregation.
Because it also there's no benefit.
What were the stipulations? Sorry, you totally went over my head.
Yes, for the advanced ones. So here we go. So you have a business,
okay,
and you have a rental property. Let's say
could your business be the rental property? Like, let's say let's give a Jane Doe example. I'm Jane Doe. I make 150. I work in I work as an IT software tech, and I just purchased a short-term rental for $500,000. What can I do, Colin?
Hold on, say that again. I forgot what you said you worked in.
IT software professional. Gonna get a tap.
Just read that one.
Yeah. No, IT. Jane works as an IT software professional. She makes $150,000. She makes 200. No, let's go normal. She makes $100,000. Jane makes $100,000. She buys a short-term rental, and she's renting it out for 40% of the year. And she paid $500,000 for the short-term rental. What can she do? How can she turn that into what advice would you give Jane?
Is she managing the property, or
she's managing? She's managing it.
Right, so that means she's an active investor, and if she made 100K or less, she gets to deduct the full amount of her loss, which could be up to not the full amount. She can deduct up to $25,000 of losses.
Okay.
It phases out between 100,000 and 150. So once it gets to 150, you can't deduct anything anymore.
And what do you mean by losses?
Losses. So usually, with the main goal with investing in the rental real estate is you have positive cash flow because you didn't pay for the entire property at once, and you get to deduct the depreciation every single year. So it's basically like getting a magical deduction for something that you haven't actually fully paid for yet. So this depreciation ends up putting losses on your tax return. We call them paper losses because you didn't actually lose money. So these paper losses are sitting on her tax return. And in her scenario, there is nothing she can do if she has losses. The only thing she can do is try to have passive income that can offset that. So that's interest income, dividend income, capital gains, and maybe she has like a minority partnership in a business where she really does nothing. That's the only
too complicated. Jane's not Jane. I don't want to discredit Jane, but she doesn't know about minority interests. She just is working her IT. She wants to get tax advantage income. She heard from a friend.
Yeah.
If I invest in short-term rentals, I can lower my taxable income some, my salary. Is that so? Are we not able to even mess with her? Is there W-2 income? She's making 100. Sorry, Jane, you're still going to be making 100. But
if she's making 100, she gets to do it. She's making 150, she can't do it.
Okay, she's making 100, and then out of that, her short-term rental she paid $500,000 for it, but her short-term rental, let's say it makes $30,000 a year.
$30,000 before any depreciation stuff?
Before any depreciation. So she still gets to depreciate, and explaining to people in layman's terms, you basically get to write off your purchase price over 27 and a half years, correct?
Yep. So that she has a $30,000 profit. Her depreciation won't be enough to give her a benefit to lower her taxes.
Hmm.
But if she did a cost segregation, which is basically when you analyze all the different parts of the rental property, from the appliances to the fences to the roof, all of that, to
Hmm.
accelerate the depreciation. So you could try to shift like $100,000 worth of the value of the house to like 5 or 7 or 10 years. Then
Yeah.
she might have a paper loss, even though she had that $30,000 in profit for the year. And she'll be able to deduct, if she's at 100K, $25,000 from her W-2 income.
Gotcha. Can she write off the mortgage interest and stuff like that?
Yeah, mortgage
I,
interest you can deduct, the principal you cannot.
gotcha. Um, so just for our scenario, and I use my phone calculator real quick. If we're depreciating at a standard depreciating of 27.5 years, she gets to write off right around $18,000 every single year for depreciation. And if her mortgage interest is, $1,000 a month, it's going to be more than that. If her mortgage interest is $2,000 a month,
And we have
um,
property taxes to take into
property
account.
taxes. So, I mean, she'll have a loss there
Yeah.
from her. So, and then let's say she makes $30,000, but paper losses. So, with those depreciation in mortgage interest and taxes and property insurance, let's say she's negative $20,000 every year.
And
Does
she's
that
making,
does
she's,
that
yeah. So if
does
she's
that come
making
off her
100K
income?
or less and
Yeah.
she's paper loss negative 20 every year, that's a direct deduction from her 100K W-2 income. So
Mm.
now on her tax return, she's making 80K instead of 100K.
Ooh, see,
Yeah, there you
I
go.
actually didn't know where this conversation was going to go. I have some theses about short-term rentals, and that a lot of people have been buying them because, and you're saying because they classify as an active investor because they are actively involved in renting. And let's just be clear, she would have to be actively involved. So communicating through, let's say, Airbnb, for instance, to set up the tenants, communicating, dispatching out if there's a repair or dealing with the cleaners. So
Yep.
you'd have to actively be doing it. I mean, it's its own business.
Yep.
But you're saying technically she could lower if she had a $20,000, and it's kind of hard to explain paper losses. I think you did a pretty good job, but for most people that aren't in real estate, sometimes it's hard for them to conceptualize what it is, where you're not actually losing $20,000. You get this kind of paper loss because you're writing that property off over 27 and a half years, but she gets to lower her income to $80,000. That's a big benefit. That's probably why a lot of people, but she can't make more than 150. If she makes more than 150, then what happens?
The loss just sits there. It'll roll forward every single year for whatever
Uh-huh.
reason she dips below, or it can offset other forms of passive income. So for her, she's not advanced, she said. So interest income, dividend income, capital gains. That's how you
Those,
can offset it. So if your portfolio
okay.
grew a lot in one year, you can try to do the tax loss harvesting we talked about to lower that amount and rebuy your stocks 30 days later. That's your best bet. It's probably not going to sniff the 25,000 that you have as a loss, but it'll do something.
Yeah. No, that's cool. And were there any other advanced strategies that we missed? I'm sure there's a bunch of advanced strategies. There's
There
tons.
are, they mostly are specialized in who they apply to, especially if you're at a company with stock options. But in general, these are the best strategies that anyone can do that doesn't take very much time at all. Like, I think
Gotcha.
out of all of the strategies we discussed today, the most time consuming would probably be going to a dealership and test driving the cars that you want to buy. That's
Yeah.
it.
Cool. I think we kind of nailed it. I just want to summarize, or I would, I will ask you to summarize again. What are the best kind of tax strategies that if people really want to dive deep? And I encourage you to reach out to Colin. if you are wondering where you're at, what you need to do, just shoot Colin an email. We'll put your contact information, Colin, in the description of the video so people can reach out to you directly if they have questions or just wanted to talk more and see if they're a good fit with you. But if you could just hit kind of those main ones again that W-2 earners can really dive in deeply. Maybe they want to do more research on the internet to be like, hey, I don't even know I've never even heard of an HSA. I don't even know what that is.
Yeah, I'll be brief. That way you guys just do some research, reach out. So max out the retirement plans, max out that health savings account, max out the college saving plans in your state, only lowers your state income tax. Use all your FSA funds, do tax loss harvesting, prepay mortgage interest or property taxes, speak with someone to find out if it's going to lower you into a different tax bracket. Donate to charity if you know you're going to be itemizing. That'll be if you have high property taxes or mortgage interest. Look into the energy efficient home improvement credit. You'll find a big list of all of the items that qualify. There's a lot. You just have to make sure you purchase something that is actually qualified to improve your energy efficiency. And then finally, EV tax credit. If you need a car, it's a great way to lower your taxes. And just one more final note, when we talked about withholding again, with these withholdings, you're basically, the government's getting this money and holding on to it for you until you file your taxes. And so if you take advantage of these strategies, you're guaranteed to get some sort of refund because your withholding has no idea you're doing this. And when you get that withholding back, when you get your refund check in April, use that money to invest. That way you can grow other parts of your wealth building strategy, like real estate or investing in a business that actually have the really good tax deductions out there.
I mean, there's one last thing that I feel like most people don't realize, and it's glossed over. I didn't realize it for a really long time, and I'm a bit embarrassed that I didn't realize it. But I feel like it's prudent to let people know. When we talk about tax brackets, I don't know if you'll see where I'm going. We talk about tax brackets. We talk about, well, you just want to squeeze down, from 25 to 15. How do I get down to 25? And we often are like, I just want people to understand that it's taxed, and I don't even know what the verbiage is. It's taxed in tranches. So the first set of income is taxed at 15%, and then the next set of income is taxed at 25%. And I'm probably blowing what the tax brackets are because I'm not the professional. And then the next set is 27, and the next set is 30. But just because you lower into the lower tax bracket, the first set of income is always going to be taxed at the lowest amount. Then it goes up in tiers. So
that's why, like, if I say you're in a 24% tax bracket and you do something that will lower you by $5,000, that's why I say you're saving that 24%, because that's $5,000 is only getting taxed in that final tax bracket you're in, that higher one.
I just feel like most people don't understand that. I did not understand that. And I don't think I would venture to say, I don't think 75% of people understand that at all. They just go, oh, I want to be in the lower tax bracket. And it makes sense because that's how we say it. You want to be in the lower tax bracket.
Yeah. If you're only in the higher tax bracket by $1,000, it's not the end of the world. But if you can lower it by an extra $5,000, that's still a healthy savings.
And the biggest, I said that was the last thing. The biggest tax bracket jump is the initial one 15%?
10%.
Currently in 2023?
10% is the first one.
10%. What's the biggest jump?
It's the more money you make. So the higher up you go, the bigger the jumps seem.
I thought they jump up relatively quickly and then they kind of tear down by like 3%, but I could be totally
wrong. Honestly don't know what the exact tax table looks like, but I can pull it up.
I just wanted people to have that in there, especially W-2 earners, have that knowledge in their tool belt if they didn't understand how taxes work with getting into the next tax bracket or lowering into the next tax bracket, how it works. So you don't have to be like super worried. Oh my gosh, I bumped up by $1. I mean, your dollar is taxed at the higher tax bracket and everything else is at the lower. So don't think that it works like that. Don't be like me 5 or 7 or 10 years ago when I was like, whoa, that's the way it works. Oh,
But yeah, I mean, it still is important to remember. It's called your marginal tax rates, the tax rate that you're finally settling in.
mm,
Yeah, so sure, not everything is getting taxed at that rate, but everything you deduct from then on from your W-2 salary that puts you into the higher tax bracket, everything you deduct, you can think of it being deducted at that higher tax bracket that you're currently sitting in. So that's what makes the deduction so great. So if you're in the top tax bracket, paying like 30 something percent, every dollar you're able to deduct is saving you 36% on your taxes. It's not saving you in the tranches like that 10% and 12% or whatever. It's
Yeah.
just saving you in that final tax bracket that you're in. So it is still important to think about it that way, but not all of your income is getting taxed at one rate.
No, I appreciate the time today, Colin. Appreciate your knowledge, your wisdom, for just being continued partner. I greatly appreciate you. I know the audience well as well. So again, if you guys want to reach out to a tax professional, to a bookkeeper, to an accountant, please reach out to Colin over at Windstone Financial. We'll have his contact information in the description of the video. And we'll see you guys on another episode.